Welcome to the deep dive. Today we're traveling back to 2010.
Yeah, just 2 years after the big financial earthquake of 2008.
Exactly. The immediate crisis is, well, mostly behind us at this point in time, but the aftershocks are huge. We're talking about the regulatory response.
Dodd-Frank, that legislative tsunami, as you called it,
Yeah.
it was just starting to really hit the shore.
And it threatened to completely reshape, well, everything in finance.
So what we've got is a kind of time capsule. It's the 2010 shareholder letter from JPMorgan Chase.
A giant right in the middle of it all.
And it gives this, unfiltered look inside, how they saw their recovery, their plans for growth, and maybe most interestingly, their takes on all these new rules.
Right. So our mission here is to sort of cut through the usual corporate speak. We want to get at what they were really thinking. What was the actual ongoing cost of that 2008 crisis? What was their game plan for growth, both here and globally? And why were they being so, frankly, outspoken about some of the regulation?
Well, the headline numbers kind of set up the tension right away. They reported record net income $17 billion for 2010.
Which sounds amazing, right? Up 48% from 2009. Like, crisis over, victory declared.
Yeah, you'd think so. But then, right in the letter, they kind of tap the brakes.
They say their return on tangible equity, 15%, should actually be higher. They felt they could be earning, what, $22 to $24 billion.
In what they called a more normal environment. So there's this gap, right? $5 to $7 billion missing from their potential profit.
And that gap, that's really the story of 2010 for them. So what was the biggest thing holding them back? What was that main drag?
It was definitely the past catching up with them. They point specifically to these extraordinarily high losses from mortgages, mortgage-related stuff.
Still? Even in 2010?
Yeah, still. Running at about $4 billion a year after tax. So even as things stabilized elsewhere, that toxic mortgage legacy was still, bleeding them.
Which brings us straight to Washington Mutual. WAMU. They bought them right in the thick of the crisis, end of 2008.
September 8, yeah.
So how could they possibly call that acquisition clearly still worth it when it was causing so much financial pain? I mean, isn't that just spin covering up a mistake?
Well, it's a fair question. But if you look at the numbers they shared, the actual operating business of WAMU, the day-to-day banking, that part was doing okay.
Okay. Ow.
It brought in about $2.7 billion in 2010, which they said was pretty close to their initial expectations, like around $3 billion. So the core business they bought was performing all right.
So the problem wasn't the ongoing business, it was the baggage it came with.
Exactly. It was all about the massive, unexpected, one-time costs from that WAMU mortgage portfolio they inherited.
And those costs were worse than they thought.
Significantly worse. They'd already written down $30 billion when they bought WAMU, which was huge.
Right.
But the letter admits the final hit from those mortgage losses was another $3.2 billion higher than even their conservative estimates. So the pain was real. It was expensive.
Okay, so if the present was painful, the justification for saying worth it must have been all about the future potential then.
Absolutely. It was a strategic play. They saw WAMU as giving them a huge footprint, especially on the West Coast, for things like commercial banking, small business lending, areas WAMU wasn't really playing in effectively.
Ah, okay. New opportunities.
Yeah. They specifically forecast that just the small business banking part within that old WAMU territory could eventually bring in maybe $1 billion a year pre-tax.
So take the hit now.
Take the hit now, deal with the legacy mess, but secure a dominant position in key regional markets for, decades to come. That was the calculation.
But that $4 billion drag, it wasn't just an accounting issue. There was a really painful human side, particularly concerning military families. The letter addresses this head on.
It does. And it's quite stark. They acknowledge mistakes, serious ones, in how they serviced mortgages for U.S. military members, including wrongful foreclosures.
Which is just awful.
Yeah. The CEO called it a painful aberration. They apologized publicly, said they were fixing the errors, and launched this whole new program, focused on hiring veterans, offering better financial products for military families. It was clearly a major reputational issue they had to tackle.
Okay, so that's dealing with the past. Let's pivot to how they plan to build the future. Coming out of the crisis, what were their priorities for using their capital? What does that tell us?
It tells us they were thinking long-term about actual business growth, not just financial maneuvering. Priority number one was investing in organic growth, meaning building out their existing businesses, creating better products, expanding their reach, real business building.
Okay, and number two?
Strategic acquisitions. But they stressed price sensitive. They weren't just going to buy anything.
And only then, way down the list, was buying back stock.
Right. Only if they couldn't find good ways to invest in growth first. That was the message.
Which leads to something I found really interesting. We're in 2010, right? The digital age is booming. Everyone's talking about online banking killing branches. Yet JPM decides to aggressively expand its physical branch network, going from opening about 120 a year to over 200 planned for 2011. Why? In that environment.
It seems counterintuitive, doesn't it?
Okay.
But they claimed their own research showed something surprising. While, yes, ATM use in online banking had soared,
Yeah.
the actual number of people coming into branches hadn't really dropped. It had stayed pretty steady.
Ah, really?
Yeah, so their bet was that physical presence for building relationships for certain types of transactions still really mattered. They wanted dominance in key markets, and they figured each new, mature branch could make over $1 million in profit annually.
Okay, that makes some sense. It wasn't just about the average customer either, was it? They were also targeting wealthier clients more directly.
Correct. They launched Chase Private Client Services. The plan was about 150 dedicated spots, basically sections within branches or standalone offices, to cater specifically to their roughly 2 million affluent customers.
People needing more tailored investment advice, wealth management, that sort of thing.
Exactly. Building out the service infrastructure to match different customer needs. Not one size fits all.
Now, looking overseas, the strategy seemed quite different. It was all wholesale, right? Following the big corporate clients.
Precisely. They saw the biggest growth potential in their global wholesale bank, supporting the really big players, the global Fortune 2000 companies, large institutional investors, sovereign wealth funds. These clients were growing way faster than the global economy overall.
And they were putting their money where their mouth was, expanding rapidly in places like Brazil, China, India.
Yeah, they mentioned their client coverage in those countries jumped from maybe 200 to 700. They were adding capabilities to handle the Chinese renminbi, opening branches in cities beyond just Beijing or Shanghai, like Guangzhou and Chengdu.
Following the clients, building the infrastructure.
But what really stood out, I think, was a long-term view. They actually talked about sub-Saharan Africa.
Really? Back in 2010?
Yeah, predicting its economy would more than double, from $800 billion to $2 trillion over the next couple of decades. And they explicitly said, look, the investments we're making there now, they won't move the needle on profits, short-term.
Right.
But they expect a real payoff in decades to come. They use the phrase, planting the field now.
Wow. Planting financial trees they won't sit under for 20 years. That's quite a long-term perspective for a public company judged quarter by quarter.
And they tied that back to their definition of a quality business.
Yep.
It wasn't just about profit figures. It was about having good clients, great products, constant innovation, top-notch systems.
And not taking dumb risks for short-term gain.
Exactly. They stressed that chasing short-term results by taking excessive risk always leads to paying for it later. Quality meant sustainable long-term value.
Okay, let's talk innovation. They highlighted a couple of tech things they were doing to improve the customer experience. What were those?
Yeah, the first one was called Chase Instant Action Alerts. This was pretty neat for the time. It wasn't just a notification on your phone.
Like you're about to overdraft.
Right, but it was a two-way. You could actually text back a command, like transfer $50 from savings, right there and then to avoid the overdraft fee.
Ah, interactive.
Yeah, and they said they already had over 10 million mobile customers using it.
Okay, and the second one seems standard now, but was a big deal then.
That was Chase Quick Deposit, using your iPhone camera to deposit a check.
Mobile deposit. Game changer.
Huge. It won a bunch of Best of 2010 app awards.
Mhm.
It showed they were really focused on making banking easier, more intuitive, using the tech that was just emerging.
And given the whole post-crisis vibe, the focus on treating customers fairly, they also made an internal structural change, didn't they?
Yes, they set up these consumer practice groups within each consumer-facing business, run by senior people.
And their job was?
Basically, to review everything, all the policies, the products, the pricing, the procedures, from top to bottom, to make sure it's fair to the customer.
And they had teeth.
Apparently. They were given the power to right a wrong, fix individual customer issues, but also to permanently change processes they found were flawed. An internal watchdog, essentially.
Okay, that brings us to the final big piece. The regulatory storm, Dodd-Frank and all that.
Yeah.
So they weren't just completely against all regulation, right? They supported some reforms.
That's important, yeah. They were clear they supported things aimed at making the system safer, like higher capital requirements, more liquidity.
Things banks need to hold.
Right, more buffers. They supported the new Financial Stability Oversight Council, FSOC, to watch for systemic risks. They supported resolution authority, basically, a way to wind down a failing giant bank without causing chaos.
Okay.
They were on board with stress testing, which the Fed was doing, and even things like stronger rules for clawing back executive bonuses if things went wrong.
So they supported strengthening the system overall. But the support definitely stopped when rules started to hit their core business operations, particularly market making and client services. Let's start with the Volcker Rule.
Right. The Volcker Rule aimed to stop banks from making purely speculative bets with their own money proprietary trading. JPM said, okay, fine, we accept getting rid of pure prop trading. But they strongly objected to how the rule was being applied to market making. The proposals would effectively triple the regulatory capital they had to hold against the inventory needed for market making.
Okay, can you quickly explain market making for us? Why is tripling the capital hurt?
Sure. Market making is. Think of the bank as the essential middleman. They hold inventories of stocks, bonds, etc., so that big clients, like pension funds or companies, can buy or sell large amounts quickly without crashing the price.
They provide liquidity.
It's exactly liquidity. JPM argued that if you triple the capital cost of holding that inventory, that cost gets passed on. It makes it more expensive and potentially harder for companies to issue bonds or for investors to trade efficiently. It could actually, slow down the whole economy.
Making it harder for the markets to function smoothly. Okay. What about derivatives? They had big issues there too.
Yeah, they called one part of the derivatives regulation a spin-out provision, an operational nightmare.
Spin-out, meaning?
This rule would have forced banks to move certain types of derivatives, credit, equity, commodity derivatives, out of the main bank entity and into separate subsidiaries.
Why did they hate that idea? Seems like isolating risk.
Their argument was the opposite. They said, look, the main bank is where the capital and the oversight are strongest. If you force these critical risk management tools outside that structure into lots of smaller, potentially less capitalized entities, you actually make the system more fragmented and harder to manage if one part fails. They argued it increased systemic risk, didn't decrease it, made it riskier, not safer.
Okay, that's counterintuitive. Now, the regulation they seemed to oppose most fiercely was the Durbin Amendment. Debit card fees.
Oh, yeah. They did not hold back on that one. Called it price fixing at its worst. Strong language.
Why such intense opposition? What was the core issue for them?
They claimed it was rushed through Congress with no fact-finding, analysis, or debate. But the fundamental problem, they argued, was that the law limited the fee banks could charge retailers for a debit card swipe to only the incremental cost of that specific transaction.
Okay, what does incremental cost mean here, and why is that a problem?
It means basically the tiny cost directly associated with that single swipe processing. It explicitly excluded all the massive fixed costs of running the whole debit card system.
The ATMs, the branches, the security systems, the fraud prevention.
Exactly. All the infrastructure that makes debit cards work safely and conveniently. The law basically said you can't charge for any of that, only for the marginal cost of the swipe itself.
And the banks predicted consequence of ignoring those fixed costs.
They argued banks would have to recover those costs elsewhere, meaning higher fees for basic banking services for consumers.
Making banking more expensive for regular people.
Yes. And they went further, citing estimates that this could push potentially 5% of American families out of the banking system altogether, making them unbanked, which would undo years of effort to bring more people into mainstream finance.
A potentially huge negative social consequence. Okay, last big regulatory piece. Overall capital levels. Basel III JPM argued the new requirements were just too high, right? Overkill.
Their argument was based on their own experience during the 2008 crisis. They said, look, our capital levels back then, under the old Basel I rules, about 7% Tier 1 common, were perfectly adequate. We weathered the storm, even acquired 2 failing giants, Bear Stearns and WAMU.
So 7% worked in the worst crisis ever. Why force us up to 10% or more under Basel III?
Exactly. They argued that forcing banks to hold that much excess capital, far beyond what was needed for safety, actually harms the economy. Because that capital is just sitting there, idle.
Instead of being lent out, invested, fueling growth.
Right. It becomes a drag on economic activity.
And this tied into their concern about global competition, didn't it?
It did. They worried that if the U.S. imposed these really high capital standards and the Volcker Rule and other stringent measures, but banks in Europe or Asia didn't adopt the exact same rules,
Then U.S. banks would be at a disadvantage.
Yeah, more costly to operate, less able to compete globally, potentially losing market share to foreign rivals.
Yeah.
A major concern for them.
So wrapping up this deep dive into 2010, it really paints a picture of this kind of split personality, doesn't it? On one hand, record profits, markets calming down.
Yeah, a sense of recovery.
But on the other hand, still dealing with that huge $4 billion annual hangover from the mortgage crisis and facing this just unprecedented wave of new, complex, and in their view, sometimes damaging regulation.
Absolutely. And their stated goal, which I thought was interesting, wasn't to predict exactly what would happen. It was to be prepared to operate, to thrive under widely variable conditions. They knew the future was uncertain.
And they specifically warned that maybe the biggest risk wasn't another single Lehman-style event.
Right. But the sheer volume and complexity of all these new rules hitting at once, thousands of pages of regulation applied potentially unevenly across the globe. The risk was in the cumulative effect, the unintended consequences.
Which leaves a really interesting question for you, the listener, to think about. JPM raised serious objections to 3 major regulatory pushes, worrying about the unintended damage they could cause. Which one do you think posed the biggest long-term risk of negative consequences for the broader economy?
Was it the Volcker rules' potential impact on market liquidity and funding costs?
Or the derivative spin-out, which they feared could actually make the system more fragile?
Or was it the Durbin Amendment, potentially raising costs for consumers and pushing millions out of the banking system?
Volcker, derivatives, or Durbin, which carried the biggest hidden danger back in 2010. That's the complex reality they were navigating.